It's the afternoon of January 16th, 2026, and the screen in front of you is lying. If you're watching the mainstream tickers right now, all you see is red. Silver is getting crushed, down more than 3% in a single session. Gold is sliding with it. The talking heads are out in force, declaring the end of the metals mania, announcing that the commodity supercycle has finally slammed into a brick wall. Scroll through financial news or leave CNBC on in the background, and the message is crystal clear: the party is over. But here's what they're not telling you. While silver is going through a violent emotional flush, while retail traders panic, sell, and fear merchants scream about a great metals crash, there is one metal sitting quietly, almost unnervingly calm: copper, trading at $5.86 per pound. Not collapsing, not spiking, just holding the line like it's welded to the floor. I've been analyzing commodity markets for 12 years, and I built this channel for one reason: to cut through the noise faster than the mainstream can spin it. I'm not here to hype you up. I am here because I saw something this afternoon that couldn't wait 12 hours for some talking head to finally mention it after the move was already over. While everyone else is staring at the exit sign, I'm watching the VIP entrance. And what I saw was this: Amazon Web Services just bypassed the public market entirely to secure copper directly from the source. A 2-year direct offtake agreement with Rio Tinto. Not through the LME, not through paper contracts. Direct physical supply. Samsung is doing the same thing. These are not speculative trades. These are strategic acquisitions. These are the world's largest technology companies deciding that copper is a resource they simply cannot afford to be without. So ask yourself this: if copper is just another industrial commodity about to crash along with everything else, why are the biggest corporations on the planet locking in multi-year supply contracts right now? Why are they willing to pay above market rates just to guarantee delivery? The screen is telling you one story. The shadow market is telling you another. And if you think today's silver flush is the real story, you're about to miss a tectonic shift that has been building beneath the surface for more than a century. What we're witnessing right now isn't just a market rotation. It is the moment copper stops being treated like a commodity and starts being treated like what it actually is: a strategic asset. The new gold. Institutions are front-running the public, quietly securing supply before most people even realize there's a shortage coming. Here's the thesis, and I need you to understand it clearly, because everything else builds from this point. Copper is no longer just a commodity. It is becoming a strategic technology asset that Amazon, Samsung, and every major player in the AI and electrification race are locking down before the public markets wake up to the structural shortage. This is not about short-term price action. It's not about riding a hype wave. It is about recognizing a fundamental shift in how the most critical infrastructure metal on Earth is being valued and allocated. We are in what I call the great decoupling. Gold and silver are increasingly being treated as fear trades, insurance policies. Assets you buy when you're worried the system is breaking. And don't misunderstand me, I stack physical silver. I understand that world. I've been in it for over a decade. But copper is being treated differently. Copper is infrastructure oxygen. If you're building the future, you need copper. AI data centers, electric vehicle fleets, renewable energy grids, high-speed rail. Every single technology meant to power the next 20 years of human civilization requires massive amounts of this metal. And here's the uncomfortable truth the mainstream financial media doesn't want to talk about. Supply cannot respond to this demand for at least a decade, not because of a temporary bottleneck, not because of logistics issues, but because of the physics of mining. It takes 12 to 15 years to bring a new copper mine online from discovery to production. Ore grades have fallen more than 30% since the year 2000. The easy copper has already been pulled out of the ground. At the same time, demand is accelerating at a pace that would have sounded insane just 5 years ago. In this breakdown, I'm going to do 4 things. First, I'll walk you through the exact market structure we're seeing right now: price action, inventory behavior, institutional positioning, the real-time signals that matter while the mainstream is still writing yesterday's headlines. Second, I'll explain the macro rotation mechanism, specifically the copper to gold ratio, which is one of the most important signals for understanding when markets shift from defense to offense. Third, I'll run the actual supply and demand math, not hype math, to show why $5 per pound isn't a bubble top. It's the new floor. Fourth, I'll address the strongest counterargument to this thesis and explain why it fails. Finally, I'll share my personal battle plan. Not advice, not recommendations, just the exact triggers I am watching and how I'm positioning myself as this cycle unfolds. This isn't a trade for tomorrow. This is a cycle signal that's been building for 175 years, and it is about to break into public consciousness in a way that will catch most people completely off guard. The real story isn't the red flush on your screen. It's the shadow withdrawals happening behind the scenes. Let's get into the on-the-ground reality. Earlier this afternoon, here's what the snapshot looked like. Gold trading around 45.88, down over $20 on the day. Silver at 88.55, a brutal 3% dump. This is the kind of move that makes retail traders question everything they thought they knew. And then there's copper at $5.86 per pound. That copper price is critical. While precious metals are getting hammered and headlines are screaming about the end of the commodity cycle, copper is holding firm, not rallying, not collapsing, just holding. In markets like this, stability is more telling than any explosive move. When you look at the structure, copper is sitting in a high liquidity battle zone, despite risk-off sentiment, despite panic selling elsewhere, despite every excuse to sell in sympathy. Copper refuses to break the 550 to 580 structural support range. This is what I call tectonic stability. It's not exciting, it doesn't trend on social media, but it tells you something incredibly important. There are very large hands underneath this market that are not willing to let it break lower. Now contrast that with silver. Silver is experiencing a classic red flush, emotional, volatile, driven by paper traders responding to headlines and fear. And I understand why retail is nervous. A 3% down day forces people to ask whether a larger collapse is coming. But this is where the paper market and the physical market diverge. While paper traders dump silver contracts, physical giants like Amazon are signing multi-year copper offtake agreements directly with miners. Amazon isn't speculating. They're not flipping copper for a quick gain. They are securing supply because they've done the math on how much metal they need to power their data center infrastructure. And they're willing to bypass public markets entirely to guarantee delivery. That behavior doesn't happen during a crash. It happens when insiders know supply is about to become scarce. So ask yourself what they know that the screen doesn't. The silver flush is real. The fear is real. But the quiet drain on physical copper inventories is real too. I've watched commodity markets long enough to know that when the disconnect between paper pricing and physical behavior gets this wide, you follow the physical market. You can print paper, you can shift sentiment, but you cannot print copper mines. Now we need to talk about the macro rotation because this is where most people get lost. The copper to gold ratio sounds boring, but it's one of the most powerful indicators in all of macroeconomics. It measures the market's preference between defense and growth. Gold is the ultimate defensive asset. You buy it when you're scared, when you don't trust currencies, when you want insurance. Copper is the industrial workhorse. You buy it when you're building grids, factories, data centers, and transportation systems. In simple terms, you buy gold when you're hiding. You buy copper when you're building. And when the copper to gold ratio falls, the market is in fear mode, defensive posture. When it rises, the market is shifting into offense. Right now, that ratio has just completed a major corrective phase and is turning higher. I'm not saying gold or silver are dead. I am saying the market is beginning to favor the metal that represents growth and infrastructure over the metals that represent fear and preservation. This shift is slow. It unfolds over months and years. But institutions don't wait for confirmation from the media. They position early. If you're holding only defensive assets right now, you may be positioned for the last war, not the next one. Here's the analogy that makes it click. In the early stages of a war, you dig bunkers and stockpile ammunition. That's gold and silver. But to win, you eventually have to build supply lines, factories, and infrastructure. That's copper. The copper to gold ratio is telling us the market is moving from bunker mentality to build mentality. Look at the evidence. AWS, Samsung, declining LME inventories, accelerating corporate offtake deals. The rotation isn't coming, it's already here. The ticker just hasn't caught up yet. Now we need to do the math, because if this argument can't survive real numbers, then it's just another hot take floating in a sea of financial noise. Let's start on the demand side, specifically with what I call the EV and grid gap. A traditional internal combustion engine vehicle uses roughly 20 kilograms of copper. That's your basic wiring, starter motor, alternator, and a few auxiliary systems. An electric vehicle, by contrast, uses about 80 kilograms of copper. That's a fourfold increase in copper intensity per vehicle. And this isn't a marginal change at the edges of the auto industry. Every major automaker on the planet has publicly committed to transitioning most, if not all, of their lineup to electric over the next 10 to 15 years. Now scale that reality up to the global level. Worldwide vehicle production runs at roughly 80 million units per year. If even half of those vehicles transition to EVs over the next decade, that alone translates into an additional 2.4 million metric tons of copper demand coming purely from the automotive sector. That number doesn't rely on optimistic assumptions. It doesn't assume full adoption. It assumes only partial transition, and it still produces a staggering increase in demand. But the automotive story is only the first layer. The real wild card, the one that simply wasn't priced into copper markets 5 years ago, is AI data centers. A single large-scale data center can require anywhere from 5,000 to 10,000 metric tons of copper. That copper goes into electrical distribution, cooling systems, backup power infrastructure, transformers, and high-speed interconnects. And we're not talking about building one or two of these facilities. We're talking about hundreds. Microsoft, Google, Amazon, Meta, and every major cloud provider are in an arms race to deploy AI infrastructure at scale. Every incremental watt of computing power requires copper to move electricity, dissipate heat, and prevent system failure. Then add renewable energy into the equation. Solar farms, wind installations, grid-scale battery storage, transmission upgrades, all of it is massively copper intensive. A single offshore wind turbine uses roughly 8 metric tons of copper. Solar installations require several metric tons of copper per megawatt of capacity. The International Energy Agency has been clear that to meet global climate and energy security targets, renewable energy capacity must roughly triple by 2030. That projection isn't an optimistic scenario. It's the bare minimum to stay on track. When you add EVs, AI data centers, renewable grids, and baseline industrial demand together, you're looking at a locked-in, multi-decade demand profile that simply has no historical precedent. This is not cyclical demand that disappears when GDP growth slows. This is structural demand embedded in the physical requirements of modern civilization. Now, let's talk about the supply side, because this is where the story becomes deeply uncomfortable. New copper mines take, on average, 12 to 15 years to move from discovery to production. That timeline includes exploration, permitting, environmental review, financing, construction, and ramp-up. That is not a worst-case scenario. That is the industry average. At the same time, ore grades have declined by roughly 30% since the year 2000. In plain language, mining companies now have to move about 30% more rock to extract the same amount of copper. The high-grade, easy-to-access deposits have already been mined. What remains is deeper, lower-grade, more energy-intensive, and more capital-intensive to extract. So not only does new supply take longer to arrive, but each incremental ton of copper costs more money and more energy to produce. Now let's run a simple stress test. Assume global copper demand grows at just 3% per year. That's a conservative assumption given electrification trends, but let's use it anyway. Global copper demand today is roughly 25 million metric tons annually. 3% growth means the world needs an additional 750,000 metric tons of new copper supply every single year, just to stay balanced. Here's the problem. There are not enough new mines in the development pipeline to meet that growth. According to industry data, if current trends continue, the copper market faces a cumulative supply deficit approaching 10 million metric tons by the end of this decade. That is not a rounding error. That is a structural gap. It cannot be closed with marginal efficiency gains. It cannot be closed with minor recycling improvements. And that brings us to recycling, which is often presented as the magic solution. Yes, copper is highly recyclable. Roughly 30% of global copper supply comes from recycled material. But here's the part that's always left out. Recycled copper cannot consistently meet the ultra-high purity standards required for advanced applications like AI cooling systems, high-speed interconnects, and next-generation EV motors. You cannot simply melt down old plumbing and wiring and turn it into semiconductor-grade copper. The metallurgy doesn't work that way. High-performance applications require virgin material with extremely tight impurity tolerances. Recycling can help meet baseline demand, but it cannot fill the gap for the high-tech sectors driving the next wave of growth. Now here's where the math gets even more interesting. At first glance, a long-term copper price of $5 per pound looks expensive. Many investors assume the market is already pricing in plenty of upside. But $5 per pound is not hype. It's increasingly looking like the new floor. When you factor in inflation across mining equipment, energy, labor, and regulatory compliance, the all-in sustaining cost for many copper producers is already approaching $4 per pound. That leaves a margin of roughly $1 at current prices. That is not sufficient to incentivize massive investment in new mines. For the industry to justify the capital required to close the supply gap, copper prices need to be sustainably higher, likely in the $6 to $7 per pound range. That reality is not reflected in today's paper pricing. This is why I describe the setup as a tectonic grind rather than a tsunami. This is not a short-term moonshot. It's a slow, grinding revaluation as physical copper disappears into long-term corporate supply chains faster than new supply can replace it. And that leads to a critical question. If the math is this clear, why isn't copper already at $10 per pound? To answer that, we need to address the strongest counterarguments head-on. The most serious argument against this entire thesis is recession. A prolonged global manufacturing downturn where purchasing managers' indices stay below 50 for an extended period would hit industrial demand. In that scenario, critics argue the copper supercycle collapses. EVs, AI infrastructure, and renewable grids all assume continued capital investment. If credit tightens and governments pull back, demand disappears and copper prices fall. This is not a straw man argument. It's legitimate. Yes, copper is cyclical. In a severe recession, demand would take a hit. I'm not going to pretend otherwise, but here's where the traditional playbook breaks down. The direct offtake deals we are seeing tell us that major corporations are no longer optimizing for price. They're optimizing for availability. Amazon isn't trying to time copper prices. They're de-risking their supply chain because they know that if they wait for a downturn, the copper they need might not be available at any price. This is what makes this cycle different from past commodity booms. Historically, demand was flexible. Projects could be delayed. Construction could be paused. Today's infrastructure demand is not optional. If you're building AI capacity, you cannot indefinitely delay data center construction without falling behind competitors. If you've committed to an EV transition, you cannot simply abandon it without destroying your long-term business model. Demand may slow in a recession, but it does not disappear. And here's the trap. When prices fall during a downturn, mining companies don't ramp supply. They cut exploration. They delay projects. They preserve cash. That means when demand inevitably recovers, the supply deficit is worse than before. You cannot idle a mine development project the way you idle a factory. Once a project is paused, years are added to the timeline. This is the supply trap. The second skeptic argument is recycling, which we've already addressed. Recycling helps, but it cannot meet the purity requirements of high-growth applications. The third skeptic argument centers on China. China consumes roughly half of the world's copper. A prolonged slowdown would hurt demand. That's true. But China is also the largest investor in renewable energy, EVs, and grid infrastructure. Even as property construction slows, electrification spending accelerates. And beyond China, demand is increasingly distributed across India, Southeast Asia, and emerging markets. So yes, a Chinese slowdown would matter. It would not eliminate the global structural demand story. After steel manning the bearish case, the conclusion is clear. Recession risk explains volatility, not the long-term trend. The structural supply deficit remains. The electrification mandate remains, and supply cannot respond quickly. You cannot print copper mines. So what happens next? This is where we move from theory to real-time market signals. I'm watching the LME and COMEX closely for changes in margin requirements. When physical inventories decline and volatility rises, exchanges often raise margins. That squeezes leverage out of the paper market and is often an early sign of stress in price discovery. I'm also watching what I call shadow withdrawals. Exchange inventories only show registered warehouse stocks. They do not capture copper being pulled into private corporate stockpiles through direct offtake agreements. Copper secured by AWS or Samsung will never appear on an exchange report. That's the blind spot. The screen shows you one story. The physical market tells another. And in commodity markets, the physical market always wins in the end. So here's the scenario most people aren't prepared for. You can have a market where official inventories look stable or even slightly elevated, while the actual available supply for immediate delivery is quietly evaporating. This is what I call the dark inventory phase. The most important metal on Earth stops being meaningfully available on public markets because it has already been allocated through long-term corporate contracts. If that sounds extreme, look at what happened in lithium. Major automakers didn't wait for spot shortages to show up on an exchange ticker. They signed multi-year, direct supply agreements with miners and processors, bypassing the public market entirely. By the time retail investors noticed lithium prices exploding, the physical market had already been spoken for. Copper is heading down the same path. Now let's talk about the media narrative, because this is where behavioral psychology comes into play. Expect financial media to stay laser-focused on silver's volatility. Not because silver matters more, but because volatility generates clicks. Fear drives engagement. A 3% down day in silver is a headline. A steady, boring grind in copper over 6 months is not. The media isn't trying to deceive you. They're optimizing for attention. And attention is drawn to drama, not to slow structural shifts. So the story will be about a metals crash, the end of the commodity supercycle, retail traders who got caught chasing precious metals hype. Meanwhile, institutions will quietly continue securing copper through off-exchange deals. This is classic misdirection. Keep the crowd fixated on the shiny, volatile asset while the real move happens in the dull, slow-moving one that nobody is watching. Here's the dashboard I'm personally monitoring to track how this unfolds. First, LME inventory levels. I'm not looking for a dramatic collapse. I'm looking for a steady, grinding decline that persists, even when prices are flat or slightly lower. That would tell me price is no longer the clearing mechanism. Availability is. Second, the $5 rollers 50 floor. If copper continues to hold above $5.50 per pound during the next broad market sell-off, that would confirm the decoupling is real. It would mean copper is no longer trading as a purely cyclical industrial metal. It's trading as a strategic tech asset with a structural bid underneath it. Third, the spread between futures prices and physical premiums. If physical premiums begin widening meaningfully above futures, that's a signal the spot market is tighter than the paper market implies. We saw this exact dynamic in the early stages of the oil super spike in the 2000s. Futures markets remained complacent, while physical barrels traded at growing premiums because real supply was constrained. I want to be very clear about something. None of this happens overnight. This is not a meme stock style squeeze that explodes in a week. This is a multi-year structural trend that grinds higher so slowly most people won't notice it until it's already behind them. Copper could chop between $5 and $6 for months. It could even dip toward the mid-4s if we get a sharp recession scare, but the underlying fundamentals do not change based on short-term volatility. The supply deficit doesn't vanish. Corporate positioning doesn't reverse. Locked-in demand doesn't evaporate. Here's what I believe is the most likely path over the next 12 to 18 months. Precious metals remain volatile. Gold and silver have sharper rallies and brutal pullbacks. Retail traders get whipsawed. Analysts keep calling tops and bottoms. Copper, meanwhile, grinds. It holds support. It occasionally spikes on supply disruption headlines, but most of the time, it simply refuses to go down. Quietly, corporate procurement teams continue locking in multi-year contracts. Exchange inventories continue trending lower. Mining companies keep reporting delays, cost overruns, and permitting issues. And at some point, maybe late 2026 or early 2027, the market wakes up to the reality of a structural shortage. That's when the real move happens. Not because of speculation, not because of a short squeeze, but because the physical market has already been cornered by institutions, and price has no choice but to adjust. That's the playbook I'm watching. Now let me be very explicit about what I'm doing personally with this information. This is not advice. It's not a recommendation. It's simply my own framework. I'm watching the copper to gold ratio closely. If it continues trending higher while silver remains suppressed or range-bound, I'm personally shifting focus from precious metals toward industrial tech metals. That doesn't mean abandoning physical silver. I've been stacking for 12 years. That's my insurance. That's my wealth preservation. But when it comes to asymmetric upside over the next 12 to 24 months, copper is where my attention is moving. So how does a retail investor actually gain copper exposure? You have a few options. Physical copper is one, but it's bulky, heavy, and illiquid. Futures and CFDs provide direct exposure, but they introduce leverage risk and rollover costs, and they're not something I'd touch casually. For most people, the cleanest exposure comes through copper mining equities. Personally, I look at diversified vehicles like the Global X Copper Miners ETF, ticker COPX. It offers broad exposure to major producers, giving you operational leverage to copper prices without single company risk. Now, here are my specific triggers. Trigger 1. If copper closes a week above 580 while broader markets are selling off, stocks down, precious metals weak, risk appetite negative, I'm increasing exposure, that would tell me institutions are defending that level and the structural bid is real. Trigger 2, if copper breaks below $5.20 on a sustained weekly basis, I step aside. Not a one-day flush, but a clean break. That would signal recession forces temporarily overpowering the structural story. I'd wait for a new base to form. I'm not interested in catching falling knives. I'm interested in confirmed trends. Now pause here, because this is important. Look at the bid-ask spread in copper derivatives. Liquidity is thinning. Market makers are widening spreads because they were uncertain where the next wave of buying or selling will come from. When liquidity dries up in a market that's supposedly bearish, it's often a sign that the bearish phase is ending. This is where battles are actually won. Not in headlines, not in sound bites, but in bid-ask spreads, open interest data, and warehouse withdrawal reports released at 4 a.m. that nobody reads. So my plan is simple. I monitor copper daily. I track the copper to gold ratio weekly. I watch inventory data and corporate supply deals as they emerge. If copper confirms strength above key levels, I rotate exposure accordingly. If it breaks down, I wait. And through all of this, my physical silver stays untouched. That's not my growth trade. That's my insurance policy. The goal isn't to get rich quickly. The goal is to be positioned on the right side of a multi-year structural shift before it becomes obvious. Here's the recap. Silver is the headline. Copper is the chapter that follows. The AWS and Samsung deals are the first drops of a coming corporate wave where tech giants bypass public markets to secure strategic supply. The macro rotation from defensive metals to industrial tech metals has already begun. The ticker just hasn't announced it yet. My forward-looking view is measured. Over the next year to year and a half, copper likely grinds higher in a way that frustrates both bulls and bears. It won't be clean, it won't be dramatic. It will be choppy, range-bound, and boring on the surface. Underneath that surface, however, the forces are aligning. Supply chains are tightening, inventories are declining, new mine development is stalling. Demand from EVs, AI infrastructure, and renewable grids is accelerating. At some point, the paper price will be forced to reconcile with physical reality, and that reconciliation will not be gentle. I'm not saying copper goes to $10 tomorrow. I am saying $5 is the new floor for a world that has no choice but to electrify. If you understand what it means for a critical infrastructure metal to transition from commodity status to strategic asset status, then you understand why institutions are positioning now. Donna T. let the red flush on your screen blind you to the tectonic shift happening in the dirt. The era of copper as just another industrial commodity is over. The era of copper as strategic tech gold has begun. While the mainstream writes obituaries for the metals mania, smart money is hardwiring the future with the one metal that cannot be printed, synthesized, or substituted. You can ignore it. You can wait for confirmation from television. Or you can watch what the institutions are doing. They are not trading copper. They are acquiring it. The metals crash narrative belongs to yesterday. The copper supply crisis belongs to tomorrow. And tomorrow is closer than most people think.